Thank you for watching this video. Today we will be doing technical analysis on the stock market for Wednesday, October 28th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. The Simple Market Signals proprietary model helps financial advisors and individual investors understand the current level of risk in the stock market as well as the trend direction, allowing you to make better, more informed decisions, all for less than $20 per month. Today, the S&P 500 was down 3.53%, and we closed at 3271.03. The first chart that we're going to look at is a 1-minute, one-day candlestick chart of the S&P 500. So each candlestick does represent 1 minute of trading. And what we can see here is right from the open, the market was selling off, and we sold off all day and closed right at the lows of the session. And before I forget, if you are a Simple Market Signals subscriber, I sent you a very important email this morning with updates on the model, and that went out at 9:45 here this morning. So if you are a Simple Market Signals subscriber, please make sure you look for that email from me. Went out at 9:45 Eastern Time this morning. And guys, if you're not yet a Simple Market Signals subscriber, I would encourage you to take a serious look at what I do, because it works. It really helps. Okay. Now let's move on to a 3-minute, 3-day chart of the S&P 500. So that's this week, Monday, Tuesday, and Wednesday. And you can see here that we continue to sell off. And of course, today we gap down at the open. And as we just saw on the 1-minute, 1-day chart, we sold off all day and closed at the lows of the session. And again, we were down 3.53% on the S&P 500 today. So pretty bad day in the market. And in this 1-month, 30-minute chart of the S&P 500, we can see that we are in a downtrend and have been since the market peaked back on October 12th. So we are now trading below where we were a month ago. So obviously just even eyeballing that, right, we can see that we're negative for the month, and we're in a pretty serious downtrend at this point. And then when we look at support levels, and this is a 1-year, 1-day candlestick chart, the support levels, any of you that have been watching my videos for a while know that I was talking about this 3420 support level. And, you know, there wasn't a ton of support there, as I've been pointing out over the last few weeks, but it was an area of support. Well, we broke beneath that, obviously, and now we're beneath this 3330 level, which had been a pretty important area of support and resistance going clear back to the first of the year. So now that we're below 3330, the next stopping area possibly is 3210. At this point, I think, you know, that normal technical analysis tells us that we're probably going to at least 3210 at this point. And the next logical stopping place, if 3210, where this blue line is here, and of course that, you know, support and resistance goes clear back to the end of 2019. But if this 3210 area does not hold, then the next logical place where we might find some support is at the 200-day moving average, this green line here, which is setting at about 3129. So, and you can see here that, you know, the 200-day moving average oftentimes does provide some level of support. So if the market continues to sell off, and it sure, you know, it sure is acting like it's in a downtrend that doesn't want to stop here, at least for a little while, 3210 and then the 3125, 3130 area would be the next areas that we really need to keep our eye on. And then when we look at the performance numbers for today for other investments, we of course know that the S&P 500 was down 3.53%. The DIA that tracks the Dow Jones Industrial Average down 3.35. The IWM that tracks the Russell 2000 small caps down 3.07. MDY that tracks the S&P 400 mid-cap index down 264. The triple Qs down 390. The RSP down 306. That's the equal-weighted ETF for the S&P 500, down 3.06%. And the SPY that tracks the S&P 500 down 341. And anytime you see a difference, whatever it is, whether it's 1 basis point or in this case about 12 basis points difference between the SPY, the SPY, and the SPX, the S&P 500 index itself, that's just tracking error. That's nothing to worry about. And in this case, it went in favor of the SPY, right, the ETF, because it didn't fall quite as much. It's down 12 basis points less than the index itself. And so, sometimes whether you're using the SPY or IVV or one of those other ETFs or any mutual fund that tracks the S&P 500, if you ever see a difference between the index itself and the performance of your mutual fund or your ETF, that's just tracking error. So it's not a big deal. Okay, it does happen. Now, guys, the next thing, and I want you to really pay attention to this. Okay, high quality bonds. So let's take a look at the kind of two of the most popular ETFs that track the treasuries, the IEF, the 7 to 10 year treasury. Now keep in mind, we're down over 3.5% on the S&P 500 today, right? The 10-year treasury ETF was down a basis point, and the TLT, the 20-year ETF, was up 9 basis points. Okay, so any of you that are in a 60-40, 70-30, 50-50 type portfolio, and you're using high quality bonds to help offset equity risk, I just want you to get your head wrapped around the fact that this isn't your grandfather's stock market anymore, okay? And bond yields are, and maybe I should better say this isn't your grandfather's investing environment anymore, would probably be a better way to say that, because, guys, we're in a very peculiar setup here where bond yields are so low and we're trading right at the same PE ratios based on everything I can see that we were at the tail end of the 1990s. So we have some of the highest stock valuations that we've seen in decades, okay, and that extends to the indices. We have the lowest bond yields, some of the lowest bond yields we have ever seen, and we're in a situation where high-quality bonds just are not going to be in a position to offset equity risk like they used to a dozen years ago when the 10-year treasury yield was, 4.5%, 5%, okay? And let me, just bear with me here, because this is so important for you to get your head wrapped around, especially if you are an asset allocator or any of you guys that are financial advisors. I think you know exactly what I'm talking about here. And this goes back to, we have to change our paradigm. We have to change the way we are thinking about investing in these static portfolios, because they're not going to work very well going forward, okay? So let's take these two high-quality ETFs and let's extend these out to a week. Now, they're slightly up for the week, okay? Up 27 basis points on the IEF, and the TLT is up 126. But let's go back and change our 1 week performance on the S&P 500. We're down 4.79% on the S&P 500 this week, and we're up 27 bips on the IEF and up 126 on the TLT. So they've helped this week. But now let's go back a month, okay? So over the last month, the IEF, including this week, right, is up. Is down 84 basis points, and the TLT is down 230. All right. So during these last few weeks when the stock market has been falling, these bonds have not done the job that they used to in offsetting equity risk. Okay, and even the more conservative stuff like the DIA, a lot of people would intuitively think that that's going to hold up better than other areas of the market, and it's down the most, right? 586 over the last week, where the S&P 500 is down 479 and the triple Qs are down 442. So, guys, what I want you to really get your head wrapped around and start to think about is, number one, cash is an asset class, and this is, it's up to you, right, how you think about this. But I'm sharing some philosophies and I'm sharing some facts with you that cash is an asset class. And in my way of thinking, okay, you're going to need, going forward, based on super low interest rates and very high price to earnings ratios on stocks and just the setup, you're going to have to seriously entertain the idea of adjusting your equity exposure up and down to match the risk level of the stock market. I think the people that can do that will do that, get their head wrapped around it, and have a system for doing that, something that is market-based. You're going to be much better off going forward because you're going to be able to lower your equity exposure during those times when the risk-reward ratio is not in your favor, and then increase your equity exposure to the markets when the risk-reward ratio is more in your favor, okay? And so what I'm talking about here is market risk. And just to illustrate a point, let me point out something. Today, okay, I looked up, just before making this video, I looked up a couple of statistics for you. The triple Qs, the NASDAQ 100, okay? In the triple Qs today, and the overall triple Qs were down 3.90%. Okay, there's 100 stocks. A lot of you realize that. That's the NASDAQ 100, right? 100 stocks in there. There was one stock in the entire NASDAQ 100 that was positive today. The S&P 500, okay, 500 holdings. There was 16 stocks in the NASDAQ 100 that were up at least a basis point today, all right? So you had, what is that, 484 down, 16 up, okay? That's called market risk, and this is what I'm talking about, guys. Most people don't fully appreciate the fact that up to 90% of all stocks, and sometimes more, okay, go in the same general direction as the overall market. And in the past, people used to use high-quality bonds to offset equity risk. Guys, it's not going to work very well anymore, all right? Yeah, these things were, flat to slightly up today, so you didn't lose as much as you did in the equities. But you're going to have an anemic portfolio at best if you continue down the road of, the 60-40, 50-50, 70-30 type portfolio, because the yields on these bonds are just too low to help you. And I hope I've made the case. But anyway, so went on a little bit of a rant, but hopefully you guys are taking some stuff away from that. So with that said, I'm going to tee up some more information here about simple market signals and how I can help you. But guys, don't take this market lightly, because the chances are there's at least more downside here, and hopefully we'll get lucky and stop somewhere between this 32.10 and 31.25, 31.30 area. But we could definitely see even more downside than that. So hopefully we won't, but none of us know for sure where the bottom of this downturn is, but we're definitely in a downtrend, and it seems like we're picking up momentum on the downside, as you can see here, because you can see on these charts that we were in a downtrend, but now that seems to be accelerating, right? It's accelerating to the downside. So possibly something can come out overnight, stimulus agreement, whatever, that could give us a pop to the upside. That might happen, but I wouldn't count on it. So be careful here, and keep your stops tight, and seriously consider working with me. Guys, what I offer is less than $20 a month, and it really, really works, and it helps people, okay? At the very least, it'll help enhance what you're already doing as far as a risk management system. Let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information. and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m. But it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders. Because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription, and then again the standard newsletter goes out every weekend. But we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.